Okay, good morning everyone. We're going to start our Monday webinar now. Okay, so okay. Okay, here's the outlook for the markets. We'll start with the US market. So the S&P 500 fell 3%. So the US market has finally had a correction. We were expecting a correction for the short term for the past 2-3 weeks based on weakness in the consolidation. So last week, S&P fell 3%, mainly due to disappointing results from retailers. Macy's, Walmart, Cisco, and Nordstrom gave disappointing results and negative guidance for the year. We feel that, well, continued weak results could fuel this correction, and bond news spiked on Fed jitters. However, in the long term, equities we believe still have legs in the longer term. The macro data still generally is supportive of a longer term bull. Second half, global GDP is expected to be stronger than the first half. Inflation is still not yet a concern. The longer uptrend for stocks is intact, pending a short correction. And energy has not assumed leadership yet. And Warren Buffett recently revealed that he spent $500 million on Suncor Energy, which is a bet on oil sands. That's good for energy. Okay. For the macroeconomic snapshot, I just want to reiterate that it's not all doom and gloom. US job claims dropped to its lowest since 2007 October. Eurozone is finally out of recession, and global PMIs are turning up. Corporate earnings momentum also seems to be turning up in Singapore. Okay, so here are 4 charts. The chart on the top left shows global PMIs above 50 and seems to be turning up for the short term. Okay, gross exports of Singapore seems to be cycling up as well in terms of momentum growth quarter on quarter, 3 months moving average. As long as PMI exports, if they turn positive, we expect corporate earnings to follow suit. As you can see, Asian corporate earnings as well as Singapore corporate earnings 3-month average seems to be turning up. So this is good for the second half of the year. Okay, let's go to the S&P 500 chart itself. You'll notice that despite the 3% sell down, we are still in an uptrend. We're still moving in this channel. Okay, and let's dive deeper into the daily. Before we do that, let's just show the sector performance. We see based on the last 2 weeks that cyclicals have taken a dive. Okay. We believe industrials could be the next to come down. Okay, here's the reason why. When we look at the industrial sector ETF itself, we notice this is the 6-month. We notice a gap down since last week onto resistance, onto support here. Because our numerous breadth indicators are either diverging slightly or a lot, we believe there's weakness in this consolidation. So probability-wise, I believe that there could be a short-term bounce off this support level, followed by further downside. But of course, this is just our best guess. We have to wait for price to drop below this dotted line here at 44.6 before we can actually confirm a target down here. So because industrials also look for further downside, we believe short-term S&P will continue coming down. So as we mentioned 3 weeks back, that there was weakness in this consolidation here. We noted that the PPO, percentage price oscillator, which is a percentage MACD, did cross 2 weeks ago. RSI had a divergence, but more importantly, the McLaren oscillator was showing weakness. So that's why we mentioned that the probability of a downside break was higher, and we had that last week. Okay, so now that we have a downside break, let's talk about targets. Our immediate targets basically is 1650, which we actually already hit and bounced off. So now we have an indecision candle here. Next target would be 1625, and finally 1550 to 1575, which is actually this blue zone here, marked by the June lows, is a possible target. Okay, a very big support lies at 1490, which is actually the bottom, of this long-term channel. So anything close to that would be a good buying opportunity if price makes it to that area. Here are just some probabilities that I think where the retracement will go to. 10% chance it bounces off, 40% chance it hits to the blue zone. Okay, so for the intermarket and sector analysis, okay, we have once again same story. Bonds, bond prices have long-term uptrend, but short-term is weak. But we are biased to the downside. Okay, industrial commodities are consolidating, but we believe this is a consolidation which will have further upside. On a short term, we do see that for the industrial commodities, there is a short-term breakout over here. So we'll have to see how far this can break out. But in any case, the weakness in the bonds, uptrend in stocks, and the consolidation and move up from commodities seem to corroborate that we are still at phase 4 of the business cycle over here, which means stocks have not topped out yet. Hence, any major correction should be seen as a buying opportunity for stocks. Okay, sector glance over here. Today I only want to just focus on this middle one, the XLE, which is the energy ETF, energy sector. And if you're looking at the bottom half of the chart shows the relative strength between the XLE and the SPX. What I just want to show is that energy had not taken leadership versus the SPX yet at all. Leadership looks like this chart over here at XLY, where you have a typical uptrend. This shows leadership versus the SPX. So energy has not taken leadership, and hence because energy has not taken leadership, we see that. We see that this corroborates as well. We are still at phase 4 because the last phase of the stock market high is usually marked by energy taking the lead. Okay, so now here we go on to Asian indices. Okay, S&P, Singapore Index, Hang Seng, and CSI 300 are all generally on long-term uptrends. Just note that China, for the first time, made a double low. It has not made a lower low. Okay, it's held for the first time. That might be significant. Okay, the Nikkei is consolidating. Support zone is here, 12,500. Okay, so on the daily, the Nikkei, we are resting on support right now. Any breakage of this blue support line at 13,650 would imply downside to this level over here, towards the 13,000s. For the Hang Seng, we actually have a bullish configuration and is testing the green support right now. On a closer inspection, we see that it has indeed broken out. We did mention a few weeks back that a break of 21,500 implies a target of 22,170, which we indeed hit already over here, and then to 23,000. So we're waiting to see whether it can actually hit here. Thai index is an uptrend, and right now we are consolidating within an ascending triangle. So we need to keep our eyes on this to see which way the price breaks out. Whether it's going to break out from this top resistance over here, which implies for the upside, or whether it's going to break down this blue base of the triangle, which implies for the downside. Okay, Jakarta index. Well, it was consolidating, but it seemed to have broken out of its triangle pattern. So now, if this is indeed a true breakdown, let's look at retracement levels. And we essentially we believe that the major support zone will be this blue zone over here, which is the 4250 to 4400 level. This marks strong resistance, strong support. If price gets there, because it's the confluence of the congestion support here, plus the lower channel trend line, plus it's also a key Fibonacci retracement level. So we believe that if price gets to this blue zone here, it should bounce off here. Probability that it bounces off is quite high. Okay, KLCI is still bullish, but we believe it's still overbought. It's overbought because of RSI and stochastics. It has a mild divergence. So a continued consolidation or mild pullback will not surprise us. Okay, KLCI, if the price does break through this blue zone, the next target would be this zone over here at 1720. Okay, finally, STI. STI price had stalled at 32.60 a few weeks back, and so now we're on a short-term downtrend. If this continues going down, a good support zone would be this blue zone over here. So we believe that if the price gets into this blue zone here, this would be a good buying opportunity, especially if it's toward the lower side of the support zone. Okay. If you look into the daily, we see that we have an indecision triangle, indecision candle right here, just below the support line here. So we want to see if today we'll stay under this price. If the price stays under this line, then there will probably be further downside, and the targets is as follows. Just remember that this is key support over here, this blue zone over here. Okay, so any movement to the blue zone over here will probably be a good buying opportunity. So right now, okay, the market summary. Okay, S&P is correcting for 3 to 5, probably last for 3 to 5 weeks. Okay, Asian indices are lagging at key technical levels, trying to catch up. And finally, we should wait for the short-term correction essentially to be over before we can consider a buying opportunity. Okay, so now we have Ken to give us the season update.
Hi, this is Ken. Just some updates on the companies that reported their results last week. On Ezion, which we actually initiated just recently, revenue was up sharply 81% year-on-year. Net profit was also up a healthy 29%. Ezion also will be giving a 1-for-1 bonus issue. And on the results were in line with our expectations, and we expect quarterly earnings to trend upwards as new vessels start contributing. On PCRT, we actually downgraded it from accumulate to neutral. On the operating segment, the second quarter net operating income from the Shenyang properties was down 26% due to tenant loss and lower rental income. Distributable amount was relatively flat. The strong leasing activity in Jihua Mall improved occupancy in shopping mall met expectations, but the office seemed lagging. PCRT's dividend payout in FY 13-14 is fully supported by earn-out arrangements. However, to note, operating performance of the 3 Shenyang properties are crucial to avoid major decline in payout from FY 15 onwards, whereby it's no longer supported by earn-out arrangements. On Hobby Investment, we have also downgraded it from buy to accumulate. As expected, there was a muted performance in the residential properties development. Second quarter's revenue dived down sharply 96% year-on-year due to lower recognition of revenue in the residential property development. Second quarter PATMI was also down sharply by 64%. We continue to see sluggish demand for luxurious residential, and we expect weak local residential sales for the rest of FY 2013, with unsold inventory remaining concentrated in Sentosa. However, that said, we continue to have an accumulate due as we remain positive on greater amounts of overseas opportunities, such as Myanmar, coming through. We also see a huge potential revaluation gain from the metropolis by the end of 2013. On Quartz Asia, we maintain a buy. First quarter results were decent with earnings of 7 million, which was up marginally year-on-year. Sales volume, however, disappointed due to a lack of popular new launches and lower credit approvals given in Malaysia. This lower credit approvals was actually done deliberately as management see a bit of weakness in Malaysia economy. Expansion leading to short-term drag on net profits as newly opened stores in Malaysia takes time to gain traction in terms of sales volume. Higher profit margins are expected once these stores mature and efficiency is optimized. We continue to be positive on Quartz based on its unique credit offering and strong expansion plans in Singapore, Malaysia, and Indonesia. In Malaysia, it has opened one mega store and is expected to open one more within the next 6 months. In Indonesia, we will be looking at 2 mega stores opening in the near term. On GLP, we should talk about more later. Q1 PATMI of US 204 million was up 33.3% year on year on higher fair value gains recognized for investment assets. And since more we cover later, I'll just bring out the, that we stay positive on GLP's long-term growth prospect as a market leader, and also due to its strong business fundamentals. On Singtel, we maintain and accumulate first quarter results of 897 million was relatively decent. However, revenue was down 5.3%. This was due to lower revenue from Australia. Note that even though revenue was down, EBITDA actually increased. This was due to very good cost management, especially in area like Australia. The for FY14 guidance was actually revised downwards due to FX depreciation, including a sharp depreciation expected on the Australian dollar. Excluding the FX impact of management guides that business fundamentals remains unchanged and strong. Singapore and Australia Group Consumer is positive on data monetizing, and the management reiterate that Australia's focus is on retaining and optimizing profit, not customer growth. This will probably lead to a continued revenue decline, but increased EBITDA contributions. On Amara, we continue to have a buy on it due to stellar second quarter performance, whereby revenue was up 15.1%. Favorable financial performance can be mainly attributed to contributions from property investments and development segment, rental revenue from opening of 100 AM in November 2012 in Singapore. As we expect current levels of strong recurring income to continue, maintain watch on overseas venture for profitable development projects. On Pan United actually recently acquired 34% of the CXP for 100 million. This was actually due to the Macquarie International Infrastructure Funds liquidating, as previously we have discussed about, and this brings its stake of the CXP to 85.3%. We believe that this 101 million represent a fair purchase price, and earnings should steadily grow with the Chinese economy over long term. On second quarter revenue, the growth was mainly on the basic and building material. That would be the ready-mix concrete and cement. And the contributions from the port was flat despite higher volume, as they were unable to increase fees on the port. We lower expectations from buy to accumulate as we due to the lack of port fee increase. However, at current price, Pioneer is starting to look attractive once again. On Thai Bev, non-rated, revenue was down negative 11% year on year. Non-alcoholic beverage was negative due to the Pepsi contract with Thai Bev expiring, and therefore leading to a huge decrease in some Sook's revenue. Beer was also negative from a lower volume from weaker sales as stacks increased in the previous year, and there were increase in inventory. Customers started to stock out on inventory in the previous quarter due to the impending tax increase. Distribution from F&N is expected to be used to pay down debt, and management is focused on variety of products and deepening of route to market. The F&N synergy needs more time, however, due to some obstacles faced along the way. On Nam Chong, second quarter NPAT was up 81% year on year, and revenue is up from progressive recognition of revenue from 7 PSV sold and high utilization of the group's 14 vessels. Management guide for increasing E&P spending, high oil price, healthy OSV order book level, and ongoing OSV replacement cycles as positive growth drivers. Namtron is also looking to becoming more international, securing new customers in various regions. I'll now pass over to Roy.
Hello, this is Roy from Research. Today I'm going to share with you about China macro, and then later I'll talk about the GLP. So from the earlier recovery from the recovery earlier this year, the China growth has fall back to slowing down. And we say there is a rising risk that the government missing its 2013 GDP growth target of 7.5%. And we note this may be the first time that the China government missed this kind of target since 1998. The government's focus for the near term will be restructuring the economic structure, and it has already indicated a higher tolerance for the growth slowdown during the transition phase, and there is unlikely large-scale stimulus in 2013. For the three main drivers of the GDP growth, retail sales has been maintaining a double-digit expansion currently, but as you can see from the right upper chart, the growth for retail sales has been slowing down over the years. Currently, it is expanding at a rate about 13% year-on-year. And for fixed asset investment, it is fettered by the overcapacity problem following China's 4 trillion RMB stimulus back into 2009. And as we have alluded, that the government has no intention to give out large-scale stimulus in the near term. Therefore, we don't expect any bright spot. For exports, the growth is hindered by the strengthening RMB and increasing labor cost. Other key metrics also indicate a weak China economy. The July official manufacturing PMI and HSBC PMI is just standing slightly above 50%, indicating a marginal expansion in the manufacturing industries. July official non-manufacturing PMI indicates a weakening expansion momentum, while the HSBC service PMI has already fallen into the contraction territory. And the three components of the Keqiang index, which is usually used for confirm the GDP growth, the year-on-year growth for total loans and the electricity consumption, as well as the domestic cargo traffic, all show a long-term trending downward trend. So our view for China is that the nation's economy will be stuck in the low gear for 2013, and going forward, the structural reform will be the key. Next, I'm going to move to talk about global logistic properties (GLP). I'll start off with the first quarter 2014 financial result update, and then a review of the operating performance. After that, I'll talk about the investment merits of GLP and the major risks we consider. In the end, I'll give our conclusion, the rating and valuation, which is neutral, and the target price of Singapore dollar 2.8. In first quarter of financial year 2014, GLP's total revenue reported $642 million, which is down 19.6% year-on-year due to the previous Japan asset monetization to the J rate. Adjusted for the effects of the monetization and some one-off item, the Japan revenue is still down 17%. This is mainly on the weakening Japanese yen. On the other hand, the China revenue has recorded strong growth, which is up 40% year-on-year. The pipeline reported $204 million, which is up 33% year-on-year, mainly on higher revaluation recognized on the investment properties. And excluding the revaluation, the pipeline would be down 39.6% year-on-year due to the monetization. Okay, this page summarizes the operating performance in first quarter 2014. In the first quarter, the property portfolio continues expanding, and the GLP has acquired 0.58 million square meter gross floor area land for future development, and also it also acquired another 0.05 million square meter gross floor area completed logistic properties. So after these acquisitions, the total portfolio size of GLP is boosted up to 15.2 million square meters GFA in the first quarter of 2014. In China, the key focusing market of GLP, the GLP has achieved a strong development start in 2014, and which is it kickstart 0.73 million square meter GFA development in China. This is ahead of the management's whole year target of 2.5 million. The project completion in first quarter has showed our expectation. Actually, this is the second consecutive quarter that the project completion has showed our expectation. And the management explanation is that it's because some of the properties are redesigned into the multiple floor ones. Therefore, they get that we'll be seeing more project completion in the second half of 2014. I mean the financial year 2014. Okay, the new in first quarter of 2014, GLP has newly leased 0.2 million square meter GFA. This is the weakest pace since it was listed. The stabilized properties lease ratio in China has dropped slightly to 88%. But later it returned to 90% according to the management. The management also guided that it took the customers a little bit longer to make decisions. So this page summarizes our view on GLP's investment merits. GLP has the established leaderships in all the three markets it operates in, the China, Japan, and Brazil. And it has very strong business fundamentals to weather the world's economic cycle. GLP has ample cash on hand and a very low net gearing ratio, as low as 9.2%, which gives GLP a capacity to take advantage of the profitable opportunistic acquisitions in the future. Even though slowing down, China, as the world's second biggest economy, is still expanding at a very decent growth rate of about 7%, which is higher than all of the other major economies. Shorter development period required for warehouse also provides a better flexibility to quickly adjust the development pipelines according to the market demand as compared to those other tranches of the property sector. GLP has a low need for additional debt borrowing, and the future project financing will be facilitated by the further Japan asset monetization, which also entitles GLP growing and recurring asset management fee income. Last but not least, following the Japanese government's aggressive monetary loosening, we have observed some nascent sign of yield compression, which will be translating into a high property valuation in Japan. The key risk for GLP, there are many too. First, it is the high exposure to China economy, which is experiencing a slowdown. GLP has been growing concentrated in China. Currently, 56% of NAV, net asset value, is from China, and to date it has had a presence across 37 major cities. Therefore, the performance of GLP is inevitably highly correlated to the nation's consumption trend, and which we believe is unlikely to remain intact under the macro picture of slowdown. Therefore, we do not rule out the possibility that the management may scale back the financial year 2014 target project start. The other risk is the possible further weakening Japanese yen that weighs on Japan asset valuation. The weakening of Japanese yen has already had very significant impact on our current valuation on GLP. And though the Japanese government is aiming for a better outlook for the nation's demand, the most immediate impact on GLP is the decreased Japanese portfolio value through the sharply weakened Japanese yen. So for the rating and valuation, we maintain our neutral rating on GLP to reflect its increased near-term uncertainties from China, and will accordingly adjust downward the financial year 2014 target price to Singapore dollar 2.8, which is equivalent to a 1.2 times financial year 2014 price book ratio. And despite the near-term uncertainties, we still stay positive on GLP's long-term growth prospect for its market leadership and long-term business fundamentals. The clients are recommended to accumulate at the attractive price, the range between 2.6 Sing dollar and 2.65 for long-term investment. So that's all I have for you for GLP.
Hi, this is Ken here. Just like to apologize for an error in one of my slides on Ezion. The bonus issue should be 1 for 5 shares instead of 1 for 1. Thank you. Hi, we have a question on target price that we stated in the webinar. Is it derived from next resistance on the TA chart? Could the asker kindly clarify on whether this would be on GLP? Thank you.
Hello. For the 2.8 Singapore dollar target price for GLP, it is based on fundamentals, not based on technical analysis. There's another question asking about, is there a chance that GLP price will slide further, or could the recent gap be covered? Okay. So based on the fundamentals, based on the current information we have, I don't believe that GLP will be going much further down. That's why just now I said that the 2.6 to 2.65 price range will be a good enter for the long term.
Okay, there's a question. Could the recent weakening in the S&P be due to the possible tapering event, which is coming in September 17? I think a lot of the news of the tapering has really been built into the price, as this news is not new. But I think what was new that actually caused a sharp drop below the support zone was the recent news of the Macy's, Walmart, and Cisco disappointment. Because these three companies are well run and they're core retailers, so I think investors are a bit scared that if they're reported disappointing earnings, they might spread to the rest of the sector. This news is was more, I guess, unexpected as compared to the tapering event, which is coming already. How deep? Okay, next question is, how deep will the STI drop? When do you think the STI will bound out based on the chart? Okay, let me go to the chart to answer this question. Okay, well, as I said, here's the STI chart, and it has price has bounced off this resistance line here at 32.60. I would say that this blue zone over here provides very good support, and depending on how long the cycle is in the US and the negativity that abounds this to the rest of the quarter, I think that will probably determine how far this will drop. But I think odds are good that it can definitely drop towards at least up to this zone over here, 31.23. If odds are good, it can hit here. But as I said, if it gets into the blue zone, this provides good support. So somewhere towards the bottom of the blue zone would be a good place to start buying. The STI should, good chance it will bounce off once it reaches the bottom of the blue zone, which is around here, about 3,000. Yeah. Does anyone know the ETF to play China? That's not speculative. I can't answer that. It's all speculative. The corporate earnings. Okay. A question of corporate earnings. If corporate earnings of major corporations keep disappointing, but U.S. national data, for example, unemployment rates, jobless numbers continue to improve, will the Fed taper in September? Okay. Sorry. So the question is, if corporate earnings of major corporations keep disappointing, but national data such as jobless rates, unemployment rates, jobless numbers improve, will the Fed still taper in September? I guess this is a bit more speculative. The expectation is there to taper in September, but it's a bit too speculative, so I don't want to comment on this. Do you foresee a major drop in the U.S. indices? No, for the U.S. indices, we believe there will be a correction. It's either short or intermediate, but long-term trend should still be up. Hence, I put this chart up here. So if the price does break through this 50 MA over here, then I'll say there's probably a 25% chance that it will reach this level here, which is 1625. And based on looking at prior corrections and breadth indicators, there's a good chance it may even hit towards its June low over here. And I think that if it does hit towards its June low, this would be a very good buying opportunity. So there is a chance it can actually hit here.
There's a question on where we can find the audio and presentation file for webinar. Well, to find this record, you can actually go to this website called uniphillip.com, UNIPHILLIP, and under there you can look under education materials, and then from there you can look at Phillip Research webinar. Should there be any clarifications required, please feel free to contact any of us in the research team.
Okay, sorry, one question on Fed tapering. Just want to reiterate that the Fed's job is to the Fed's job is basically they only increase rates dramatically only if they want to cool the economy down. So It is speculative at this point. Yeah. Oh, hold on, please.
Hi, this is Ken here. There are quite a few questions on tapering. I think just to reiterate, tapering should start rather, when there is economic data improvements. However, the exact matrix is unknown, and we are not saying with certainty that the tapering will start in mid-September. When exactly the tapering would start is unfortunately everyone's guess. However, once again, tapering should only start when economic data is able to support. And that's probably the only amount of guidance we are able to give.
Second last one.
On the question on how long is the weekly webinar kept for, currently we actually have not removed any of our weekly webinars since we first started. So you could access any of the webinars from this website. And also it's actually labeled so that, for your convenience, it's labeled by company name. Hi, we have a question from one of the asker. Generally, is the target price, is it from TA resistance or from FA analysis? Could I just clarify that this is on GRP? Thank you. Should it be for GRP? The target price of 260 to 265 is strictly based on fundamental analysis. On when the presentation material will be available, the presentation material will actually be available by 5 p.m. today.
Okay, the question is the target price from TA resistance point or FA analysis? If you are asking for the S&P, then this is actually based on market analysis, which is essentially TA for this zone over here. There's a couple of indicators that I use, but this zone here is actually this blue zone here, which I say is a good chance of being great support, is a confluence of the June low, this congestion zone support over here. Okay. It's also a particular retracement level of the prior move earlier as well. So this is actually more technical in nature, and I'm comparing the most recent move. I'm comparing the quality of the move, its momentum, and its McLaren oscillation with prior corrections. So based on that, TA-wise probability seems to be towards over here. But we have to get past the 25 this level first, which is a 1625.
We have a question on TA chart for COTS Asia. We currently do not have access right now at this moment to the charts, but we will reply you with the chart. Yep. And on the sending of slides to the participant, we can consider that, but we will get back to you more on it, on its viability soon. Okay, if there's no more questions, thank you very much once again for participating in this this session, and we hope to see you same time next week. Thank you.